macroeconomic factor that cause the systematic risk affecting all stock returns, and this factor can be represented by the rate of return of the market index, such as S&P 500 or Kospi will be the good common factor. So the function is like that, and we can use the previous data. We can make a regression equation. And from the equation, M is the common factor. It drives innovations in security return in some microeconomic variable that affect all firms. So the M will be the same for all firms, and so that each firm has some unanticipated macro surprises. So some securities will be more sensitive than others to macroeconomic shock. So like auto firms or IT firms will be more following this M than some other like small firms. So to make it adjust, we put a beta for equation to make it following the system. Alpha explains the average return when the RM is zero. The EI is uncertainty about the firm in particular, or error term, or ledger. So if the considering many firms in portfolio, the firm specific event will be actually become means of zero. And there's total risk and covariance and correlations. Total risk are equal to systemic risk plus firm specific risk. And covariance equals to product of betas times market index risk. And correlations equals to product of correlations with the market index. And there's a portfolio variances. And in that case, the only measuring the instead of firm, use the portfolio beta and the error term. And when we are making this many portfolio, you actually see that goes to right side, which means divide by n, so it means actually it equals to 0. So with the many data, we make regressions and it lead to a security characteristic line called SCL. The SCL is plotted on a graph where the y-axis is the excess return on security over the risk-free return. And the x-axis is the excess return of the market in general. The slope of SCL is the security beta, and the intersection is alpha. As you can see from the graph, there's alpha will be showing the when the intersection with y-axis, and the slope will be beta. And each data has the errors between this line. It's a specific risk for each firms. And right bottom is the example of SCL of HP. And in that case, use the beta and alpha and error for HP, and just use M as a S&P 500. See the regression statistics, like 0.7238 multiplied is the correlation of HP with S&P 500, and it actually shows that it's quite high, which means it's quite following the market graph. And all square, which is 0.5239, the variation in the S&P 500 excess returns explain about 0.52% of the variation in the HP series. And the middle, SS, which is called sum of squares, is the portion of the variance of the dependent variable, which is HP's return. And it is explained by the independent variable S&P 500. So it is equal to beta squared times sigma S&P 500. And right middle, MS, and the cross section of residual 0.0059 is the unexpected portion of HP's returns. And you also see standard error 0.0767 is the standard error, which is equal to firm specific risk. So what is the advantage of the single index model? We learned about Markowitz model, which is SCAL. It used lots of data instead. It used lots of data. So when the analysts use this data, they have to put a lot of data on that. But however, with this single index model, they use one market index. So it reduced the number of input for diversification. And so therefore, it's very easier for security analysis to specialize. Like for example, we only have to find the data of alpha and beta and sigma square, which is specific risk. And we find one data of market risk premium and common microeconomic factor. So we only need to find 3 ends, which is if we find 5 security portfolios, we only have to guess the 152 data. If we're using the Markowitz model, might be we have to find like more than 1,000 data to estimate.
Can you explain more why alpha tells whether security is good or bad? Why?
Okay. Yeah, alpha is the. Yeah. You can see from the graph that alpha means this height, which is probably M, which is following the market, will be the same for all. And beta is dependent on the market with the specific form. And alpha is the term that use actually is the points are will start from the up or down. So if we say alphas are higher, which is start with the high position. So what really makes a security attractive or unattractive is alpha value from the portfolio manager. And more like doing from the managers, like they have to estimate the form about alpha because like probably everyone will think about the same about beta and M, which is following the previous data. So maybe analysts have to find carefully about the alpha, which is make the form like their own like analysis. And multi-factor models, like we learned from the chapter 14, it used more than one factor in addition to market return. And such as an example, this is two-factor model. We use the include gross domestic product and sensitivity for interest rate to following the each beta GDP and beta IR. So it has more terms for more like following the market. And that's for my presentation. Thank you.
Next.
Hello everyone, I'm Mai. I present about the market efficiency and empirical evidence and security returns, which refer to chapter 11 and 13 in our textbook. Before I start, I'd like to apologize that I'm not good at English, and so I think I use many wrong expressions. So please understand what I want to say by heart to heart. Okay, let's start the presentation. Okay, chapter 11 is about efficient market. How does this? Okay. I present in this order. What is the EMH? Weak form, semi-strong form EMH, and the last I tell you about the market anomaly. First, what is the EMH? Before I present about what is the EMH, I think I should think about what is the efficiency. In financial market, there are three types of efficiency. First, allocation efficiency. That means the state which all the resources in the economy are optimally allocated. When this kind of efficiency is achieved, then the assets are traded by proper prices. Second is operational efficiency. If there are less financial factor like frictional factor like the transaction cost, then you can tell the market has the operational efficiency. Third is information efficiency. This is the state which all the information is well reflected in the present stock prices. When the information efficiency is satisfied, then you can tell the market is efficient. Look at this picture. Here is a graph. It shows the compare of the prices before the information announcement and after the announcement. Here, and here, we can tell that is not efficient. But like here, when the information announcement, then that information is right, reflected in the prices and lower friendly. And so this step is, we can tell that is efficient.
Why? Can you explain why first and third one is not?
Because it's overrated and underrated.
How do you know? How do you know they're overrated and underrated?
This is the this should be the right because of information. This changes shows, but this and this is more or under.
Okay.
EMH means the financial market is informationally efficient when market prices reflect or available information about value. For the precise definition is to answer two questions. Okay, first, what is all available information means, and second one is what does it mean to reflect all available information about value. Different answers to those questions give rise to different versions of market efficiency. Here are the answers. When the all available information when the all available information means only historical the past prices, then the market is weak from EMH. And when the all available information means all public information like use and past prices, then the market is semi-strong from EMH. When the all available information means including inside information, then the market is strong from EMH. Here, weak and semi-strong and strong from EMH is the type of the EMH. And the second and third prices reflect all available information means that financial transaction and market prices using the available information are zero NPV activities. I think that is no cost and no more no more gain. Okay, next. Weak form EMH. Weak form EMH is historical information like the past prices and volume of transactions has been totally reflected in current stock prices. So when the weak form EMH is well, then an investor cannot get abnormal return by the investment strategies which based on past prices movement trading volumes. It doesn't work because their market is random work. So the technical analysis is technical analysis, which means forecasting the direction of prices through the study of past market data, primary prices and volume, and it doesn't effective in this market.
Can you explain more about random walk?
Random walk is the prices go randomly.
No.
No, I understand like that.
No. Why don't you search on the Google what does it mean by random walk hypothesis?
And if it is, it doesn't.
Okay, open the google.com and type random walk hypothesis. That's important.
Random walk.
Why don't you read first sentence?
Okay.
I
Random.
can
Ah, 이건 Q.
can you go down?
Okay.
Go down. Down. Go. How about random walk? Can you type random walk hypothesis?
Oh, where?
That's simply random walk. Type random walk hypothesis.
In here?
Yeah. Yes. That sounds good. Yes, so why don't you read first sentence?
Okay. The random walk hypothesis is a financial theory stating that stock market prices evolve according to a random walk, and thus the prices of the stock market cannot be predicted. It is
It's a historical movement of the stock price. So can you go down? Maybe there is another explanation.
more.
More. No, not many. Anyway, yeah. Yes, I think that's the correct one, correct explanation about random walk hypothesis. And if you are curious about what does it mean by random walk, you can simply type from the Google. Then there is actually mathematical formula what does it mean by random walk.
How can there be mathematical formula if you can predict?
So there is a mathematical formula for unpredictable processes. So like for example, if tomorrow's stock price is if every day's stock price is what is the ratio? For example, actually a good question. So right. So suppose actually it should be stock return, but suppose this is today's stock return. Actually it's company, so we can say it is a stock price. And if tomorrow's stock price is today's stock price plus some random component like this, and it is from normal distribution like this, and tomorrow's stock price will be look like this. Okay, and it means that historical information basically does not help. Actually, only actually I think the better information is the better notation is. In this case, so it is a tomorrow's stock price is today's stock price. So there is a change of the stock price. And if you are an investor, you are always interested in whether your stock price will increase or decrease. So it is your interest, right? So if stock price moves this way, and this one is drawn from this normal distribution, then how many data you have about the past? Basically, since this one, if they are independent of each other, so they are independent over time, then basically previous information or the information about the past prices does not help you at all to predict this part. Yeah.
What if we look at the historical prices and 3 consecutive prices actually share the similar pattern?
Similar. What do you mean by similar pattern? Okay.
Well, it looks like it's affected by the historical prices because
In that case,
increases in the same,
yes, actually there are some patterns like that, like momentum or something like
but still the random walk hypothesis does disagree with the fact that there is a pattern.
that. No. Yeah. So if there is a like for instance momentum pattern of momentum, which means the rising stock has rise in future too, and losing stock will be so loser stock will be loser in future. In that case, it is kind of momentum pattern is random the stock, okay, and that momentum pattern is inconsistent with this random pattern.
So, what random walks hypothesis is saying is the past information is useless to predict the future price, right?
past information about stock prices. So past movement of the stock price. Maybe they are relevant about accounting information or news, but random hypothesis is related weak form, efficient market hypothesis, and weak form, efficient market hypothesis about whether the past price movement of the stock price will help you to predict future price movement. Any other question? So actually there are some people generally agree that market is efficient, at least in weak form. But there are actually some empirical findings against, apparently against this weak form hypothesis. One is the momentum strength, momentum pattern. And about semi-strong form hypothesis. So again, people also generally agree that semi-strong form efficient market hypothesis work, but there are also empirical findings against that hypothesis. For example, it is well known that small stock generally generate higher return than larger stock, even after we control the beta. Maybe that. So there is a possibility that there is. So I mean, size of the firm is basically accounting information, right? It is asset size, so it is sum of the value of the debt and the market value of the equity. Therefore, there is accounting information, and using that accounting information, basically, we can predict future stock return. So that apparently inconsistent with weak form market hypothesis. Another one is like value firm and growth firm. When we define value firm as the firm with a high book to market ratio and growth firm as those firms with low book to market ratio, and it is well known that value firm actually outperforms growth firm. Okay. So again, that accounting ratio help us to predict future stock return. Right? So that is also, therefore, that apparently inconsistent with semi-strong form market hypothesis. About strong form market hypothesis, people generally don't believe that. Why don't you continue your presentation?
Turn the work. So the technical analysis forecasting the direction of prices through the study of past market data, primary prices and volume doesn't affect in this market. The way to empirical validation reform EMAs, there are three tests. First, run test. It is a non-parametric statistical test that checks a randomness hypothesis for two varied data sequences. More precisely, it can be used to test the hypothesis that the elements of the sequence are mutually independent. Second is serial correlation analysis. If the serial correlation is statistically zero, then we can tell that weak form EMAs is valid. Third, the filter rule is setting some distance, and if the price is out of the distance, then sell or buy stocks. And using this, we can analyze stock prices for fluctuations.
So what is serial?
Serial correlation is that's a real mathematical, so I can understand what is that
so you gave this explanation.
Yeah. This figure, it is about the serial correlation analysis. As you can see, the serial correlation is almost zero. So we can tell the weak form EMAs is valid in this market. Next. Semi-strong form EMAs. In semi-strong form EMAs, not only the historical information but also the all published information has been reflected in current stock prices. So in the semi-strong form EMAs market, no one can get abnormal returns by the fundamental analysis. Fundamental analysis is a method of evaluating a security that entails attempting to measure its intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. The end goals of performing fundamental analysis is to produce a value that an investor can compare with the security's current price. For the empirical validation of semi-strong EMAs, event study is used. It's the way compare of the before and after announcement. If semi-strong from EMAs is first, after public announcement, information can affect the stock prices. If semi-strong from EMAs, if the stock prices over or underreact to the announcement as we saw the picture first, then we can get abnormal return. The event study is the study of this abnormal return, so event study also called residual analysis. Next figure shows CAR means cumulative abnormal returns. And as you can see, the stock prices jump dramatically on the day the news becomes public. However, there is no further drift in prices after the announcement date. After the announcement, the CAR does not change. Then that means AR means abnormal returns does not exist. Then the semi-strong form EMAs is valid. The strong form EMAs. In strong form EMAs, not only the historical information and the published information, but also inside information has been reflected. By technical analysis and fundamental analysis calculate the abnormal return, and investment by the inside information, it also doesn't work. So in this market, so investing in portfolio is the best way to analyze the securities. For the empirical validation, many people use the comparing of mutual funds return and market returns, because many people think that mutual fund is the investor group which can get the inside information easily. Look at this figure. Market returns is more higher than the fund return. So we can think that strong form EMS does not vary. This diagram shows the relation among the EMAs types. If semi-strong form EMAs is valid, then we can also say weak form EMAs is also valid, but we cannot say that strong form EMAs is valid. Finally, I'd like to introduce about the market anomaly. It is the price and or return destruction on a financial market that seems to contradict the EMAs. There are several market anomalies, which is overreaction phenomenon, seasonal anomaly like January effect, and company anomaly like PER effect, is especially the low PER effect and IPO effect and the bubble effect. Now I present about the chapter 13, Imperial Evidence on Security Returns. First, there are many CAPM and APT tasks, but it's a mathematical task, so I want to briefly introduce the result of the test. First, CAPM test, first Wiener and Miller and Schultz's test was systematic risk and non-systematic risk. Both of them is significant between stocks beta and returns. Especially in Miller and Schultz's test, the non-systematic risk is more significant than the systematic risk. Second, Bragg, Jensen, Schultz, and Farmer beta test runs not a stock beta, but a portfolio beta. And it turns out CAPM is worse.
Really?
I read the book.
Yeah,
like
the
that.
book says that power and
Yeah.
capital is right.
Yeah, it turns
Or
out.
really?
Alright. First inference to stock return. Not same the CAPM, but they can find how many common factors exist to influence stock returns. In Chen's study, he found 5 factors can influence to stock return, but each factor doesn't show consistently by the period. And he figured out that APM is much more reasonable than the CAPM. But there are some critical from Rowe. Because we don't know the market portfolio, so when they run the test, we choose one portfolio in efficient frontier as a market portfolio. But then do like that, individual stocks returns is always linear relationship between the beta. So Rowe says that's not correct. So if we find the real market portfolio, then we can test it by that. Rowe says that's the correct empirical test, but we can't find the real market portfolio. Okay. My presentation is over now. Thank you for listening.
So next homework we'll be doing actually estimating serial correlation of the stock return. So for example, let's go to, let me close this one and close this one. So for this we can go finance.google.com, and suppose we wanna download stuff like Google, my MSFT. We can get a code for Microsoft and go to historical prices and then download to spreadsheet. Okay, it's not wrong. So it is a date, opening price, high, low price daily, and we don't need them. So we delete this part. And we don't need this part either. So it is the closing price of the Microsoft. And actually we want to change it to the daily return. So daily return will be ratio of this one and this one. Okay, so this is daily return. And to test whether we can predict, okay, whether we can predict Microsoft stock return based on previous stock return, okay. Basically, we wanna measure the serial correlation. So it is a today's return and it is yesterday's return, right? So I want to know whether using this information, yesterday's return, I want to know whether we can estimate today's return. Right? So which means that in order, if this information help to predict this one, okay, there should be some correlation between this return and this. Right? So by measuring serial correlation, basically we can do that. So this is the daily return. So basically we can do the rack actually. Yeah. Let's bring yesterday's stock return to today. Okay. So basically I match. So it is the first order called first order serial correlation. So basically I match today's stock return and yesterday's stock return and yesterday's stock return to the day before stock return, right? And then I estimate correlation between the two. So correlation between this one and then this one. Okay. And then correlation is what? Correlation seems very low. Right? So basically it is correlation, so it is basically correlation, okay, between RT minus 1. Right? And then the correlation seems very low, right? So since the correlation is actually, you can do, it is only 4%, and I'm pretty sure it is not statistically significant. So it means that today's stock return and yesterday's stock return are not serially correlated with each other. The serial correlation is like correlation with itself. Right? So past stock return, at least 1 day ago stock return is not correlated with today's stock return. Right? So which means that they are not correlated with each other. So therefore, yesterday's stock return, we can intuitively say that yesterday's stock return is not helpful to predict today's stock return. So it is correlation. Equivalent method is actually we can run the regression. Okay, so. Okay, 추가 기능. I think it takes too much. Maybe it takes too much time. But anyway, this is kind of serial correlation. So it is serial correlation. Stock return with serial correlation with 1 day ago. You can do the same thing with serial correlation with 2 days ago or 3 days ago, and you can check whether they are significant or not, and then you can know whether that helps you. Okay, past return help you to predict future return. So if serial correlation is significant, what does it mean? If serial correlation is statistically significantly positive, what does it mean?
Stock price will go increase constantly.
No, so yes, that's basically right. So if the correlation is positive, significantly positive, it means if stock prices went up yesterday, what is likely to be today? It should go right. Because they are positively correlated. So if yesterday's stock price goes up, since it is statistically significantly positive, so it means today's stock price is likely to go up as well. Which means that today's stock return is very informative to predict today, actually tomorrow's stock return, which is against weak for efficient market hypothesis. So on the other hand, if it is significantly negative, what does it mean? What should be the stock trading strategy?
Then we should buy some stock whose prices went down today.
Right. So yeah, well, basically, so if they are negatively correlated, statistically significant way, then the intuitive trading strategy would be to buy stock if stock return was low today, right? And sell stock. Obviously, stock return is high today, right? Again, if it is negative, today's stock return is actually informative to tomorrow's stock return, right? In opposite way. Therefore, again, it is against efficient market, weak for efficient market. So in your homework, actually I did it with Excel, so you can do this analysis with R. Okay. So download any stock return and check its serial correlation in order to know whether it is really positive or negative. And then at least, okay, homework should be to write a code such that it is serial correlation only 1 day ago, right? So what I want you to do is calculate up to correlation R T minus 9, 10, 2 week. So you have to calculate 10. Yes.
For the last one, the correlation of R T minus 10.
Yeah.
The correlation of R today and the time you use it.
Yes. So like 2 business weeks.
So one day and 2 days. we
Yeah.
use that.
Yeah. So to give you the hint, okay.
Professor, maybe I can do the correlation part, but I'm not sure I can find out whether it is significant or not.
Okay. Just a moment. So to give you the hint, about 10 days ago, so what you have to do is basically you move this on like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? And this one, and then okay, like this, and then basically you have to draw this part. Okay. Oh, and 2. Okay, so in this case, it seems, no, I don't think it is significant. Anyway, so it is like a serial correlation with 10 days ago, right? C2, oh no, again, yeah, so this one is matched with stock return 10 days ago, and I matched today's stock return 10 days ago, and yesterday 11 days ago, and then I calculate correlation of each other. Then it is basically serial correlation with stock return today and 10 days ago. RT and RT minus 10. And about your question, okay, maybe it is easy to calculate serial correlation, but question is whether this serial correlation is significant or not. And actually, I forgot the formula, but there is a formula for this. Okay, significance of correlation coefficient. Okay. So so there is this is a t statistic. Okay, so 1 minus r squared, and r basically this is formula. So n is the number of data. Okay, number of data, and so it's basically length of data, and r is basically correlation. Okay, r is the correlation. So by calculating it, you have t value. Once you have t value, basically you know whether that t value, by looking at the table, okay, you can see whether that t value is significant or not. So about actually in R, even using R, you can know whether t value is significant or not. So for example, actually let's start R. Okay. Okay.
Can we make the Excel file as the CSV and then import the data?
Yes, that's fine. Okay. But please write. Don't calculate serial calculation with Excel. Okay. You can just upload the data from Excel.
I don't know how to do it.
We should do it in R.
Yes, basically. Yeah. Doing with the Excel is too easy. Okay. Okay, so I think to know the significance, okay, this is the formula, okay. So R basically in our so PT is basically cumulative distribution function of the T distribution. So okay, so T distribution looks like this. T distribution looks like this. So that PT function gives the size of this area. The size of this area. Therefore, first one is maybe your this t value. Okay, t value, you can type some t value as 1.3, and then degree of freedom is basically n minus. Actually, it is basically n minus 1. So if you have 100 of data, then degree of freedom is like 99, something like that. Then you have value. If your t value is 5.0, if t value is in this case 0.3, okay, 0.3, and basically the size of this area is like 61, 0.61, which means that given the hypothesis that R is not significantly different from 0, this kind of event is likely to occur with 40% of the time. Okay, so which means that it is not significant. So PT usually, so basically when you, usually we say that when this area is less than 5%, when this area is less than 5%, then we say it is statistically significant, right? So in this case, if t value is positive, then this PT value in R, PT value should be like at least, I think, no, because we do the two-tailed test. In this case, basically, if t value is positive, then PT value should be around 0.975. Okay. And if t value is negative, and it should be here, if t value is negative, then this p value should be like 0.025, right? Okay. So again, you do this PT function in R. So first, if t value is less than the degree of freedom, and if t value is positive, this PT value should be greater than this one. If t value is negative, then this PT value should be smaller than this one. Abdul Muhi, when did you come? Yeah, I was surprised. Okay, you suddenly appeared, right? Anyway, so you understand what I'm saying? Yeah, I think you did similar exercise with normal distribution, right? But actually, in this case, we use T distribution. That's the only.
Whether significant or not is important. The important part is just the procedure, right?
Yeah.
I mean,
Yeah, of course. The purpose of the homework is to, for your practice, and the result itself is actually not important. Actually, it depends on which stuff you choose, I guess. So, do you think you can do the homework? Anyway, please discuss each other. I think Yongwon has some idea. So if you have questions, you can ask Yongwon. Okay. Okay, any other question? Okay, why don't you take a 15-minute break and then we will go to the futures concept about commodity. Okay, from this class, we will cover pricing of commodity contract. Actually, it is mostly about commodity derivatives. We learned portfolio management of commodities, and we learned futures contract already. And then from today, actually, we will investigate how to price contract about commodities. But actually, the result from of this paper is so general that actually we can apply the formula of this paper to ordinary contract or ordinary futures or ordinary option contract as well. So it is a very famous paper. It is written by Fisher Black, the Black-Scholes model, right? That Black. Okay? It is one of the great papers. And actually, instead of simply making PPT slide out of this famous paper, I think actually it would help you more to present this paper directly, okay? So that give you some reason and incentive to read the original paper. Anyway, this paper is about pricing of a commodity contract, and actually we need some notation. The spot price of a commodity, it means the price at which it can be bought or sold for immediate delivery. Okay, you already know that. So this is the definition of spot price. And for simplicity, okay, okay, let P denote spot price. P is the spot price. And then, yes, so PT is basically PT is spot price at time T. Okay. Spot price at time T. And second, the future price of commodity, as you learn, is the price at which one can agree to buy or sell it at a given time in the future, okay, without putting up any money now. So again, it is basically agreement of the two parties. You don't have to put up any money. So there is no either cash inflow or cash outflow today. Okay, cash inflow outflow will occur at the maturity date. And then we will write X for the future price or XT T stop for the futures price at time T for a transaction that will occur at time T start. Okay. So X T start is the futures price. Okay. Futures price at time T. At time T maturing at T stop. So given this definition, basically when T start equals T, okay, when the two times that specify a future price are equal, the future price must equal the spot price, right? So xt T expression holds for all time. So actually, black is identity. All time. For example, it says that May futures price will be equal to the May spot price in May, and the September futures price will be equal to September spot price in September. Okay. After we can you explain why this should work? Yeah, why they should be equal. Okay. So XTT, so again we go to this notation, XT star. So it is future price. It is agreement of the two parts to purchase. If you take long position on future, it's like promise, agreement of two parts to acquire an underlying asset at this price at time t star. Okay, so if t and t is equal, then today, okay, at this moment, you make contract with the other party such that at this moment, right now, you will sell an asset at some specified price, right? Right now, okay? Right now, so you make appointment with each other, not appointment, okay? You make contract with each other right now, and you exchange commodity. If you either deliver or buy underlying commodity at price X at right now, okay? Right? So to make the contract fair, actually that future price should be the underlying asset price, right? If you deliver commodity, you have no other reason to deliver your commodity at price lower than market price, right? And if you purchase, okay, if you are on the wrong side of the futures contract, you have no other reason, okay? You have no reason to purchase some asset right now at the price higher than market price, right? So it is maturing right now, okay? Therefore, when T and T star equal, futures price should be spot price, which means that, okay, futures price will be equal to spot price at maturity. Okay. So it is so intuitive relationship. Okay. And then we have, okay, some contract. We have some contract which are option contract, and actually in this paper, I call this contract as actually warrant. And in this paper, whenever you see the terminology warrant, you can simply regard it as just option. Okay. And then our objective is actually to calculate value of for the contract, value of the futures contract, and value of the option contract or warranty contract. That's the goal of this paper. Okay. So again, we will write V for the value of the forward contract, U for the value of the future contract, and W for the value of the option contract. Each of these values will depend on current future price. Okay. So underlying important thing is now underlying is the futures. Okay. Underlying is the futures with the same transaction time t star as the contract and the current time t as well as on the other variables. So we can write this one as, okay. So therefore, since underlying asset is future, okay, underlying asset is this x, right? So we can write this as v xt. It is Greek letter. So we have to read it as nu, okay. But for the simplicity, I'll just read in Roman way. Q and U X T, it should be W X T.
What does T mean?
Since now at time t, so value of the forward contract at time t, okay. Value of the futures contract at time t. Right? So it should be the function of the t, right? As time changes, the value of this contract will change as well. So they should be the function of time. And the value of the contract depends on the price. Okay. But first, let us investigate the forward contract. Okay. The value of the forward contract. So it is different from forward price, right? So it is futures price or forward price. So it is again different from the value of futures contract, right? So again, the value of the forward contract depends on price C at which the commodity will be bought, which is specified. We could specify the delivery price. So forward contract should depend on delivery price. And at time T star, so T star is maturity date at which the transaction will take place. Therefore, we will sometimes write value of the forward contract X. X is underlying, T is now at time T, and C is the delivery price. Okay, delivery price of the future forward contract, and T star is maturity. Okay, we will sometimes write V X T C star for the value of long forward contract. Okay. From the discussion above, we know that the futures price is that price at which for the contract have current value of the zero. It should be right. So therefore, identically, we should have So identically, we should have V. Okay. V X T X T star should be 0. Right? So instead of the C, okay, instead of C delivery price, if we set the delivery price as a futures price, okay, then it should be automatically 0 because its futures price should be fair to each party, right? So when we make contract with each other, the future price, because it is fair, therefore the value of the forward contract should be 0 each side, right? If it is positive, then seller of this contract have no other reason to enter this contract, right? If this value is negative, then no one will wanna enter this contract at a long position, right? So this one should be 0 by definition. Okay. Since this one is 0 by definition, so it should be equal to 0 always. So it is identical relationship. So in that sense, we can make alternative statement about this. So futures price, okay? Futures price is basically is the specified delivery price then make the value of the forward contract 0. Value of the forward contract 0 such that both long and short side of the forward contracts are fair. Okay, it will be a fair contract. Okay. So futures price is the delivery price such that the contract to be fair to both sides. So in effect, equation 2 says that the value of the forward contract when it is initiated is always 0. Okay, it is initiated, it should be always 0. When it is initiated, the contract price C is always equal to the current future price T star. Okay, but when as time goes by, okay, when T changes, of course, then although this contract is fair today, tomorrow this contract may be not fair, right? Either underlying asset price goes up, go down, so maybe long or short position make profit or losses. Okay, depending on the price of underlying. And increasing the future prices increase the value of long forward contract, okay, and decreasing the future price decrease the value of the contract. Thus, we should have this relationship, right? So if X is greater than C, okay, this value of the forward contract should be positive. If X is less than C, the value of this forward contract should be negative. 정주현, can you explain again why this should hold intuitively? Okay. When x is greater than c, why the value of the fourth contract should be positive? 보다는 찬원이요, 성경은 okay, 주차고. Okay, so again, so it is a value of the fourth contract. So underlying asset price is x, the value is x, and then you can pay c. Okay, at time t stop, basically you pay c, right, to acquire the asset. Okay. But actually, if you go to futures contract today, the fair price should be x, right? So basically, you pay less amount than the x to acquire the asset in the market, which can be available as x, right? Therefore, you pay less. Therefore, as your long position, you are make a profit. Okay? So, therefore, it should be positive. On the other hand, if c is greater than x, at maturity at time t star, you have to pay c to acquire an asset, right? Acquire an asset. Right? But in the futures contract, actually the fair price is that you pay only x to acquire asset at time t star, right? And x is actually smaller than c, right? So actually you have to pay larger than the market price for the future delivery price. And therefore, actually if you are long position, the value of this contract will be negative.
So in this case, the reader of this paper is going to acquire some asset, right?
Yes, acquire an asset, and by this relationship, at time t, maturity, and maturity, the value of the future contract should be value of the spot price. They are equal.
So at the maturity, the asset's price is x, but the delivered price is
No, at x, at time. So I mean, it depends on which asset you are speaking. At time t and maturity, the value of the commodity will be p, right? Value of the commodity is always p, and value of the futures contract about the commodity is x, and x and p would be equal at t star always. Because at t star, right? At t star is already maturity, so we put t star here. Then it should be equal. T star is equal to t star, right? T star, so it should be equal to spot price. Anyway, I think the more familiar relationship would be this one. The value of the forward contract will be the future price minus the spot price. So at least at the maturity. Okay, so V is the forward contract. So at the maturity, okay, spot price would be equal to X. So at the maturity, you have to pay C, and you will acquire underlying commodity. And the price of underlying commodity is P, which is equal to actually X, right? Right. Therefore, when at maturity, when T is equal to T star, okay, the value of the forward contract should be X minus C. This one looks more familiar, right? So this is the main boundary condition, which means that our goal, okay, our object, first object is to get the functional form of the Vxt, but actually we know that at t is t star will equal, we know this goal. So whatever the function it is, it should hold. When t is equal to t star, this function should be this one. Okay? So this is called the boundary condition. Okay, so when we solve this problem, okay, when we try to get this problem, we will impose this condition, okay, this boundary condition to get the functional form of this. Any question?
So the see is the contracted price for the underlying asset.
Yes, exactly. Underlying asset, which is actually futures in this case. But since at the maturity, that futures contract is actually equal to the underlying commodity price. So in this case, okay, so we are investigating the value of three contracts, value of the forward contract, value of the future contract, value of the option. Okay, but thing is that the underlying asset of this contract is all about futures price. Futures price is the underlying asset, and then underlying asset of this futures price is actually commodity. So they are basically derivative of derivative. Futures contract is derivative of underlying commodity, right? And this is the derivative of the future. So it is derivative of the derivative. Any questions? Anyway, this was intuitive, right? Okay. To acquire again the underlying asset, you have to pay E, and value of underlying is X, and basically X is the same to P at the maturity. So when the time comes for the transaction to take place, the value of the forward contract will be equal to spot price minus contract price. Contract price you have to pay, spot price is the value of underlying commodity. And the value of underlying commodity at the maturity, value of the spot price would be the value of the future contract as well. Okay. So I mean, it is a slight restatement of what you already learned. Okay, you already learned this function, this formula. So it is a value of the commodity at the maturity, and it is a price that you have to pay. Okay? If the value of the commodity is higher than what you have to pay, then you will make a profit by the difference. If value of the underlying asset, if value of the underlying commodity is lower than what you have to pay, the market value of the underlying commodity is lower than what you have to pay, then you have to buy something at price higher than market price. So you will make a loss. And then about futures contract, okay, the value of the futures contract, actually it is easy. Value of futures contract, actually we know intuitively it should be 0 always. Okay, so our goal is to calculate, get the functional form of this, and this, but we know this should be equal to 0 always, because different from forward contract, futures price are settled every day, right? Is daily settlement. Okay? Profit and loss are settled daily. Okay? Therefore, the value of the futures contract should be 0 every day. Actually, technically speaking, it should be 0 at the end of the day, after settlement, daily settlement is over. That's the big difference between forward contract and futures contract. Over forward contract, you have to wait until the maturity to receive cash or to pay cash. But about futures contract, you have to set the daily, you have to calculate profit and loss daily, and you have to pay each other. That's the big difference. So anyway, by the difference, because of daily settlement, value of the future contract should be 0. So one problem is solved. Okay, so if the investor has made money, he will give his gains immediately. Okay. And if he has lost money, he will have to pay his losses immediately. Okay? Thus, we have UXD should be equal to 0 identically because daily settlement. Technically speaking, this equation applies only to the end of the day after the futures contract has been rewritten. Okay? During the day, the future condition may have a positive or negative value, and its value will be equal to the value of the corresponding forward contract. Okay. But approximately speaking, we know this is close to 0, okay? And it should be 0 at the end of the day. Any question? And about this option, so about this boundary condition. This boundary condition is like x minus c, right, at the maturity. And we can also get the boundary condition of this option, right? At maturity, the value of the commodity option is the spot price minus contract price if that is positive or 0, okay? If negative, then option is not exercised. The warranty is not exercised. Therefore, it is 0. So writing C stop, suppose C stop for the exercise price of the option, and noting that future price equal to spot price and maturity again. Therefore, when x is greater than or equal to C stop, it should be x minus C stop. Okay. When it's negative, it is 0. Again, at the maturity, you have the right to acquire underlying commodity at price C stop. Right? And the price is P actually, but P is equal to X at the maturity. P is equal to X and maturity. So this is option pair. Okay? So actually we call this is a call option. You all know about call option, right? So anyway, equation 6 looks like expression for the value of the security option and maturity as function of the security price. The only difference is we have x instead of p, but x is equal to p. So we will solve, basically we will get the solution for x, wxt, and in order to solve this one, we will impose this condition to solve this one. Any questions? No.
It's 0.
You mean 0? So I mean it's option, right? So you have to pay C star to acquire the underlying asset. If underlying asset, if C star is greater than the market price of the underlying, then you move it to exercise the option. Right? And if you don't exercise the option, your pay will be 0. And the market price of underlying commodity is P, but P is equal to X. So that's why it's 0. Therefore, if X is less than your exercise price, future price and maturity is less than your exercise price, you will not exercise your option, therefore your pay will be 0. Otherwise, you will exercise so that you will gain the profit by the difference between the market price of the underlying spot price, which equals the future price of the maturity, minus exercise.
In that equation, there is no concept of option price, right?
That is option price, right?
I mean,
Yeah, it is option price. So this is the value of the option, okay, value of the option contract at time t stop, which is either this one or this one. The value of the contract would be how much profit you can make at this moment. No, it should be exercised at this point.
I mean, not exercising price, but the option price, which is usually obtained by Black-Scholes model. Or
So I mean, we don't know Black-Scholes model yet, but this is the option price. It is option price at t stop.
okay.
Right? So option price should be equal to the value of the option, right? Value of the option is how much profit you can make at this moment. Right? If market price is lower than exercise price, your option value is 0, therefore your option price should be 0. If market price is greater than exercise price, you can make a profit by x minus C star. So that is the value of your option. So it should be option price. Okay, and Black-Scholes model, of course, we will drive Black-Scholes model. The point is that, I mean, actually, this is also a special case of the Black-Scholes model when time to maturity is 0, because it is we are already at the maturity. So actually, it is already Black-Scholes model. But anyway, okay, the solution of this one looks like Black-Scholes model. Okay, but suppose we don't know why. But anyway, whatever it is, it should satisfy this relationship, this price at maturity. That is the point. And from this restriction, actually, we will solve this, and it will be look similar to Black-Scholes formula. Rigorously speaking, it is not Black-Scholes formula. It is looks Black's formula when underlying its futures. But anyway, you have to wait slightly to arrive at that point. Any other question? No, I mean, this is easy, right? We already learned everything. We just use slightly different terminology. Okay? Right? Okay. Are you sure? Any question? Right here? Any question? Really? Okay, then wait, I'll ask some question to you shortly.
This thing was written in 1976.
Yes. But it is so groundbreaking paper, one of the groundbreaking paper. I think this is greater than any other one. And actually, the explanation is actually more detailed. This paper provides more detailed explanation about the formula and process and everything than usual textbook, because firstly, for the first time, he explained this kind of idea in this paper. So therefore, he has to explain everything. But textbook, sometimes textbook don't explain several parts. So actually, it explains the important formula actually better than the textbook. And actually, these kind of famous economists, okay, they are also good writer. Actually, only good writer can become a famous academic researchers as well. So actually, it is actually better written than the usual textbook. And actually, I have to speak another thing. Actually, in the industry, at least in quantitative research, professional researchers usually don't read the textbook. Okay? Instead of reading textbook, actually we usually go to the underlying paper directly and we read that paper. Okay. So only amateurs, believe me. In the research, instead quantitative research, only amateurs read textbook. Professionals don't read textbook. We read underlying papers directly. And I want you to become professionals as well. Okay? So instead of textbook, that's why I use paper as our text.
You suggest other papers?
Yes, there are many other important papers, and we will cover 2 academic papers. This one and next we will cover Morton's paper.
So where do you find that paper?
Where? Actually, you can download this paper from our course web page. Okay, let's go to course web page. Course web page, and today is okay. Today is 06 and black. Okay, download this one. Connect this, and you can get paper. Okay, and then this part is actually not necessary, not that necessary, but because Black is so kind to explain this part also. But anyway, we can slightly digress to the capital S price model, and as you know, this one is equation 7. is the capital asset pricing model, right? And RI is the return on the asset I, okay, which is our interest, and R is simply return on risk-free asset, risk-free asset, and RM is return from market portfolio, and by the capital asset pricing model, we will calculation. And the beta should be looked like this. And about commodity contract, however, are not included in the market portfolio. When we say market portfolio, right, in the capital asset pricing model, we need return from market return. So basically, we have to know what is market portfolio. And when we say market portfolio, it is basically portfolio of entire asset in the economy. But importantly, that market portfolio actually doesn't include. It doesn't include derivatives. Because derivative is basically zero-sum game. So whenever we include long position of derivative, we should include short position of derivative. So they cancel each other. Right? So therefore, we don't include the derivative to market portfolio because they both sides cancel out. Anyway, commodity contract, these futures, forward, and option contracts are not included in the market portfolio. Commodity contracts are pure bet. In that there is a short position for every long position. So when we are taking all assets together to construct market portfolio, futures contract, forward contract, and commodity options are all net out to zero. So they are not the part of the market portfolio. And then about and then we want to apply this capital asset pricing model to equation 7. Okay, we want to apply this equation 7 to the futures contract. Equation 7, which is capital asset pricing, cannot be applied directly to futures contract because the initial value of the contract is 0. Right? So in the capital asset pricing model, it is model about return. But since today's initial value is 0, so we cannot define return, right? So we have to slightly modify capital asset pricing model. Okay? So let us assume that asset I has no dividend or this. So cannot be applied because the initial value of the. So we will rewrite the equation so that it applies to dollar return rather than percentage return. Okay? Because denominator is 0, so we need a formula for dollar return instead of percentage. Yes.
Initial value of contract is 0 because there's no cash flow when the contract is made, right?
Yes. At the initial point, when the contract is made, okay, these for the contract and futures contract, both of them should be. Actually, this is always 0, and even for the contract, it should be 0, right? When contract is first made, if it is not 0. If it is positive, no one short the contract. If it is negative, no one long the contract. So when contract is first made, it should be 0. But as time goes by, of course, the value of the contract can be different from 0. So anyway, we need dollar return. Okay, dollar return. So actually, we can write equation 7 to this way, right? So return is basically ratio between today's price and the change of the price. So it is return part. And we beta looks like this. So instead of RI, again we plug this part. So we have this part which is beta, and this is market premium. Right? And this one can be rewritten by multiplying PI0 by multiplying this part each side. We have this relationship. Okay, multiplying through PIO, we get an expression for the expected dollar return. Okay, not percentage return indicated on the asset. So the startup period value of the future contract is 0, so we set PI0 equal to 0, so this part is 0, right? The value of future contract is 0, so this is 0, this is 0. So therefore, this entire equation 10, will be simplified into this one, okay? Okay, this is another notation. So the end of period of future contract before the contract is released and its value set to 0 is the change in the future price over the period, right? So in practice, commodity exchanges set daily limit which is constrained, so we don't need this part. Therefore, basically, when we say futures value of the futures contract at the end of the period, which it should be since initial price is 0, so end product is actually sum of the price change. Okay. So anyway, we will assume that this limit do not exist. So Pi1 equals basically P0 is 0. Okay, Pi0 is 0. So Pi1 should be equal to the change of the price between time 0 and t, right? So this one equals to this one. So by setting this one 0 and Pi1 equals to delta P, basically this one 0. So this entire equation will be like this one, right? And then writing this part as a beta star for the first factor on the right side of equation 11. So it is like a dollar beta, okay? Not return beta. So equation 12 says that the expected change in the futures price is proportional to the dollar beta of the futures price. Okay. And therefore, if expected price change of the future is 0, which means that the beta should be 0. Because market return is always higher than risk free rate. This one is beta star should be 0. And to make beta star should be 0, actually this covariance should be 0. That means the change of the future price and then return of the market portfolio are not correlated with each other. Okay.
Professor, I'd like to ask a question about the dollar beta.
Yes.
Is it beta calculated by the level data or?
Yes, so it's basically it's level, which is same to the change of the price of future because initial price is 0.
So not divided by past price.
Yes. This is the dollar beta. Okay. Delta P and then RM. So this is return and variance of the RM. Actually, this is equal to, since delta P is initial price 0, so delta P is the price PI. So it is basically level of the price. Right? So it is covariance of PI and RM divided by variance of RM.
And the normal CAPM in the normal CAPM model, usually beta is calculated by the
Return. Yeah. In the usual capital asset pricing model, we should divide with P.
That's the difference of dollar beta and
Yeah.
return beta.
Usual beta. Okay. We cannot use that because this is 0. For this commodity, neither those with long future position nor those with short position have significant positive expected dollar return. So actually, in this classic paper, Black actually assumed that this part is 0. Okay? This part is a covariance between change of the future price and market return is 0. That's the assumption of this paper. And in the modern finance, actually, we don't need this assumption anymore by using risk neutral probability, called risk neutral probability framework. But since we didn't know that until now, and at this point, people don't know risk neutral probability density as well. So let's just assume this one. Okay, that's the beauty of this paper. We don't need prior knowledge or something more than to understand future price. So for this purpose, let's simply assume the change covariance of the change of the future price delta P, and then market return is 0. Therefore, expected change of this contract is 0 as well. Okay. So for your information, this assumption is actually not necessary. It doesn't have to. Okay, but for simplicity, let's assume this. Okay. Now futures price and spot price. When equation 13 holds, equation 13 is just this one, which means that expected future price is change of the future price is contract is 0. All the time, the expected change in the future price will always be 0. Okay, this means that the expected future price at any time ti in the future, where ti is between current time t and transaction time maturity t star, will be equal to the current future price, right? Because change is always 0. The mean of the distribution of the possible future price at ti, t prime, will be the current future price, right? So expected value, so it is interesting, right? Expected value of future price is actually today's future price, okay? Because expected change is 0. Okay? And then, however, we know that the future price at time t star is spot price at time t star because of this relationship. Therefore, so the mean of the distribution of the possible future price at time t star will be the current future price when equation 13 holds, right? Right? By this relationship, therefore, we can observe future price, right? And by this argument, this one is actually expected value of the future price because of this one. Okay? And we know delta P is 0. Okay? Okay, contract of this is 0. Okay, expectation of delta x is 0. And because this one hold, therefore this one will be expected value of this one. Okay? Again, this is not necessarily required. This kind of argument is not necessarily required in the modern finance. But for simplicity, let's keep sticking with this argument. Okay? And even when 13 doesn't hold, we may still be able to use equation 12 to estimate the mean of the distribution of possible spot price. Basically, we can use the capital as a pricing model. To use the 12, which is a dollar capital as a price model, we need to know beta star and beta star age position time between t and t star, and we know this one, and beta star and this one is maybe easily calculated. Okay. So again, even if this doesn't hold, we can use this relationship to estimate the value of futures prices. Okay, actual futures price. Okay. So to follow Black's argument, a farmer may not want to know the mean of the distribution of the possible spot price at time t star, okay? Because he may be interested in the discount value of distribution of possible spot prices. And in fact, it seems plausible that he can make this investment decision as if beta star were 0, even if it is not 0. He can assume that the beta star is 0 and thus that the future price is the expected spot price. To see why this is so, notice that he can hedge his investment by taking a short position in the futures market. Okay. Therefore, by taking the right position in the futures market, he can make the beta of his overall position actually equal to 0. Okay. He can get rid of systematic risk by hedging, okay? So, which is equivalent to assuming the beta is 0. Actually, this is the modern risk-neutral probability argument. And assuming that the farmer is not concerned about risks that can be diversified away, he should make the same investment decision whether or not he actually takes offsetting position in the futures market. So again, as I explained before, we can get rid of idiosyncratic risk by diversification, right? And we can get rid of systematic risk by hedging. This argument. Since farmer can hedge his position, so he doesn't have any systematic risk, which is equivalent to saying that beta is 0. Okay, dollar beta is 0 in this case, which is identical to assuming the change of the price. Okay, Okay, change of future price is equal to 0. Okay, and then next to get the exactly pricing of the fourth contract, and we are interested in this and this. Okay, in order to get this and this, actually we need some more assumption to calculate them. Okay, first let us assume that the fractional change in the future price over any interval is distributed log normally with best known variance rate x as star. So this assumption means that first assumption means that the x, the change of x, okay, the x, so it basically is return from x, return of the future price, right? The assumption is that the log normal distribution means that it will distribute as 0 some alpha dt, and sigma square actually is s square dt. Okay. So return of the x. Okay. So return of the x. Return of the x. This is future price. Okay. Return of the x. And then expected return is something unknown, alpha. Let's say it's given. And then, but actually we don't need an assumption about this one. It can be anything. Okay. And the key assumption of this per period, okay, the variance of this return process is s squared. Okay. Actually, there is a small argument we can use later on that. If this relationship holds, then actually we should have x squared is actually, it should be equal. Okay. When is very small. Actually, I can show it mathematically, but at this point, since we didn't study, we haven't studied stochastic calculus yet, so simply you can memorize. Okay? So when we have distribution of return in this way, the squared process of this one will be simply constant when delta t is very small. Okay? There is a mathematical reason why this is true, but that is actually not important, so you can simply memorize. Okay? Again, the squared process of this one is simply the variance of this one. And the second assumption is that let us assume that all of the parameters of the capital asset price model, including the expected return on the market, the variance of return on the market, and the short-term interest rate, all constant through time. So we assume that every constant in our model is actually constant. Third, let us continue to assume that taxes and transaction costs are 0. Okay? So there is no friction in the market. About second assumption, actually this is not that necessary. It is we assume only this for convenience. Third assumption can be important. Okay. Now let us use the same procedure that led to the formula for option on a security, which is in the Black-Scholes formula. Actually, we can create a riskless hedge by taking a long position in the in the option and short position in the future contract with the same transaction day. Since the value of future contract is already 0, the equity in this position is just the value of option. I think we don't have enough time. So again, next week we have guest speaker, and next week we will resume our class from this section. Okay.
Same time, 9 o'clock.
Beg your pardon? Yes, 9 o'clock was different class. So next class will be B103. Okay? So see you next week.